Europe's economic story in recent years has been one of navigating extraordinary challenges simultaneously: an energy shock, stubbornly persistent structural weakness in manufacturing, weak Chinese demand for European exports, and a monetary tightening cycle that hit an already fragile economy. The numbers tell the story clearly. According to the ECB staff macroeconomic projections published in March 2026, Eurozone GDP growth was 1.4% in 2025 and is projected at just 0.9% in 2026, revised down 0.3 percentage points from the December 2025 forecast due to escalating geopolitical pressures. For traders and investors, European economic conditions matter far beyond those focused specifically on European assets. The euro is the world's second most traded currency. European equities represent a significant portion of global portfolios, and Europe's economic trajectory directly influences global trade flows, commodities demand, and financial market risk appetite. The headline Eurozone growth number masks significant divergence within the bloc. According to Euronews reporting on Q4 2025 GDP data, Germany's economy contracted 0.2% in the final quarter of 2025, and that's worse than expectations. France also contracted 0.1%. Italy was flat. The biggest economies in the Eurozone, which together represented over 60% of its GDP, were all either contracting or stagnant. The core problem is manufacturing. Germany built its economic model on high-quality industrial exports, particularly in automotive and chemicals. That model faces three simultaneous headwinds: the energy cost shock from losing Russian gas supply, competition from Chinese manufacturers in electric vehicles and industrial goods, and the broader global slowdown in manufacturing investment. The ECB's own projections note that Eurozone will likely experience a continued loss of global market shares due to persistent competitiveness challenges, including some that are structural in nature. The European Central Bank has been cutting rates aggressively to support growth. According to the EY's European Economic Outlook published in October 2025, the ECB lowered its deposit rate by a cumulative 200 basis points from its 2024 peak to 2% by June 2025. JP Morgan Research in its Eurozone Outlook projected the ECB cutting further to 1.5% through 3 additional meetings, given that inflation was approaching the 2% target from above. But rate cuts can only do so much when the problem is structural rather than cyclical. Lower rates reduce the cost of borrowing for businesses. They do not rebuild energy infrastructure, restore manufacturing competitiveness, or substitute for markets that have been lost to more competitive producers. The ECB is using the tool it has, but the tools available to monetary policy are limited when the challenge is structural competitiveness. For currency traders, the ECB's rate path relative to the Federal Reserve's is the primary determinant of EUR to US dollar direction. When the ECB is cutting more aggressively or from a lower base than the Fed, the interest rate differential favors the dollar, which tends to push EUR to USD lower. When the differential narrows or reverses, EUR to USD can rally significantly. The current environment, with the ECB at 2% and the Fed at 3.5 to 3.75%, represents a 150 basis point differential in the favor of the dollar. That differential is one of the structural factors that has been weighed on the euro in recent years. Watching for convergence or divergence in the two central banks' rate paths is the most important analytical input for EUR to USD medium-term positioning. If European inflation falls significantly below the ECB's target, that forces further cuts, while the Fed holds steady, the differential widens and the EUR to US dollar faces further pressure. If European growth recovers and the ECB pauses while the Fed cuts, the differential narrows and the EUR to USD can rally substantially from current levels. Facing the challenging backdrop, European financial markets offer genuine opportunities for traders and investors who understand the dynamics. European equities have historically traded at significant valuation discounts to US equities, a discount that has widened in recent years as European economic performance has lagged. When European conditions improve, that valuation gap can narrow significantly, creating strong returns. The ECB's rate cuts, if effective, will eventually flow through to improved credit conditions and corporate investment. Germany's fiscal reforms announced in 2025, including increased spending on infrastructure and defense, represent a genuine shift in fiscal policy that could provide a meaningful growth tailwind over the medium term. The ECB's March 2026 projection specifically cited additional German government spending on infrastructure and defense as a support factor for domestic demand. For traders, Monitor German PMI data as the leading indicator for European industrial momentum. Watch the EUR to USD for signs that the rate differential is starting to favor the euro, and watch energy prices, because a sustained reduction in European energy costs would be one of the most powerful catalysts for European manufacturing competitiveness recovery. Europe's economic challenges are real. They're structural and they're not easily solved by monetary policy alone. The data from the ECB, the National Statistics Offices, and from independent forecasters like JP Morgan and EY all point to growth that will remain below potential for years. But structural challenges create structural opportunities. The valuation discount in European equities, the potential for EUR to USD appreciation if the rate differential narrows, and the long-term recovery in manufacturing competitiveness as the energy shock fades all represent genuine opportunities for those with the patience and the framework to identify them. What is your view on where Europe's economy goes from here? Drop it in the comments below. We'll see you in the next video.